According to Buffett, growth and value investing are the same. There is no difference. For decades, investors have debated the distinction between value and growth styles as though they were two opposing camps. Value investors traditionally focused on low price-to-earnings ratios, discounted assets, and bargain stocks. Growth investors, by contrast, emphasized companies with rising revenue, expanding markets, and high expected earnings growth, even when those companies looked expensive on traditional valuation screens. But Warren Buffett has long argued that this division is artificial. In his 1992 annual letter, he wrote the sentence that should have ended the debate. Growth and value are joined at the hip, meaning an investor must understand both of these styles and utilize them accordingly. To Buffett and Munger, value does not mean cheap price. Value means paying less than something is worth, and a business with long-duration growth, high returns on capital, and durable competitive advantages can be far more valuable, even at a high PE, than a statistically cheap company with poor economics. As Munger has often said, all intelligent investing is value investing, acquiring more than you pay for. The label growth simply describes how a business increases its intrinsic value over time. In other words, value investing equals paying less for what you get. Growth equals what you get in the future. The best investments combine both. For sure, watch the rest of the videos on the channel as they are designed to help you gather as much skills as possible. A company with strong growth is a value investment if the price is reasonable compared to that growth, and a company with low growth is not a value investment even if the PE is low, if future earnings stagnate or decline. The two frameworks ultimately converge in the same place: discounted future cash flows. Let's explain now why Buffett says growth is part of value. Buffett's insight is simple but profound. The value of a company depends on the cash it will produce in the future. Growth increases future cash flows, therefore, growth increases value. A fast-growing business with a durable competitive advantage could trade at 30 to 40 times earnings and still be undervalued if its earnings grow 20% to 30% for many years. Conversely, a value stock trading at 8 times earnings could be wildly overpriced if future profits collapse. These cheap value stocks are called value traps. Consider two simplified examples. Example 1, the cheap trap. A mature retailer earns $5 per share and trades at a PE of 8. At first glance, that looks cheap. But if earnings decline 5% annually for the next decade because of e-commerce competition, the business is worth far less than the headline PE suggests. The low valuation is not an opportunity, it's a warning in this case. Example 2, the expensive bargain. A high-quality software company trades at 35 times earnings but grows profits 25% annually while maintaining above a 30% ROIC. Despite its high PE, its intrinsic value compounds so rapidly that the stock can generate superior long-term returns. That was the story of companies like Mercado Libre, Salesforce, or even Amazon during their long stretches of elevated valuation multiples. Buffett's point, growth is not the enemy of value, it is a driver of value. I have designed a free PDF cheat sheet with all of the most important metrics which Buffett and other value investors like and use. Grab the free document down in the description and the pinned comment. What is the PEG ratio and where does it fit in? One tool often used to evaluate whether a high-growth stock is still reasonably priced is the PEG ratio, price earnings to growth. PEG ratio divides a company's PE ratio by its expected earnings growth rate. PEG ratio around 1.0 suggests that the valuation is roughly in line with the growth rate. A PEG significantly above 1.5 to 2.0 implies the stock may be overvalued relative to its growth prospects. Why PEG matters more for high PE stocks? PEG analysis is most useful when the P/E ratio is high, generally above 28 times earnings. Why? Low PE stocks typically have lower growth, higher cyclicality, less durable competitive advantages. Their cheapness is often a reflection of risk, not opportunity. Using PEG for them often produces misleading signals. For example, a company with 5% growth and PE of 10 gives a PEG of 2, which may look high, but the company is unlikely to justify a premium anyway. High PE stocks, however, need growth to justify their valuation. If a business trades at 30 to 40 times earnings, it must deliver strong, consistent earnings growth for several years. PEG helps assess whether the growth rate is sufficient. Thus, for a stock with a PE of below 20, the PEG is often unnecessary. For a stock trading at a PE of 20 to 28, the PEG ratio is sometimes helpful. When the PE goes above a 28, PEG becomes highly relevant. Buffett and Munger don't explicitly use PEG, but they absolutely evaluate whether the future cash flows justify the present price. PEG simply formalizes that logic. The PEG ratio was popularized by Peter Lynch, another one of the greats in the investing game. The traditional formula looks at the current PE of a stock and it takes out the compounded annual growth rate of the EBITDA of a company for the last 5 years. I personally do not like this approach as the growth assumption has already happened. I like to assume a forward-looking growth, which I personally come up with. I always take into account the current growth over the last 5 years, but I'm always much more conservative. For example, if a stock has grown its earnings over the past 5 years with 20% per annum, I would say that over the next 5 years, the stock will grow by only 10% per annum. If I am okay with that as a final result, I would think about investing. If only a continued 20% growth rate justifies today's price, most often than not, I skip the company and wait for a better time to potentially buy. We must always invest with a high degree of conservatism. We must be okay even if the negative scenario manifests itself. Even then, we must have sufficient returns. Let's see some more practical examples. 1. Amazon, high PE, high growth. For most of the 2010s, Amazon traded at triple-digit PE ratios, but revenues grew 30% to 40% annually. PEG analysis would show Amazon at a PEG less than 2 for much of the time, surprisingly reasonable given its explosive operating leverage in AWS and marketplace flywheels. Long-term shareholders were rewarded because value grew faster than price. 2. Meta, moderate PE, high growth. In 2015, Meta traded around 30 times earnings and grew profits greater than 40%, PEG less than 1.0. The market underestimated how enormous its advertising platform would become. Again, the growth rate justified the valuation. 3. Apple, moderate PE, low growth. Today, Apple trades at a PE in the low 30s, while earnings growth has slowed to low single digits, PEG greater than 3. This is one reason Buffett, despite loving the business, is gradually reducing his position. The value-growth relationship has shifted. Growth no longer supports the valuation multiple. Growth investors sometimes overpay for excitement. Value investors sometimes underpay for stagnation. Both mistakes come from looking at labels rather than business fundamentals. Buffett's approach transcends both. Focus on future cash flows. Evaluate durability of competitive advantages. Determine whether the price is reasonable relative to value. A growth company with high ROIC and long reinvestment runways can be the best value of all. A statistically cheap stock with low returns on capital can be a value trap. The goal isn't to buy value or growth. The goal is to buy wonderful businesses at fair prices. This is something which came from Phil Fisher and Charlie Munger, the only two people who managed to change Warren Buffett's strategy. Before that, he was buying the so-called net stocks, stocks which were more valuable if they went bankrupt compared with their current price. I will put this video in the description as I make a full breakdown of this strategy and history. The distinction between value and growth investing is more linguistic than practical. Growth is simply a component of value, and the long-term value of a business is determined by the cash it will produce. Buffett and Munger have shown that the highest return opportunities often lie where value and growth converge. High-quality companies with durable competitive advantages, high returns on capital, strong reinvestment capacity, and valuations aligned with future growth. Ultimately, all true investing is value investing, and the very best value often comes wrapped in growth.